Welcome to another Southbank investment bulletin. Well, the US government finally got together over the weekend and decided that they were going to keep the government open for at least the next 6 weeks. So there was pretty negative sentiment about that last week, and especially as we were heading into the end of the quarter. But you can see here that the market pulled back the S&P down from just under 4,600 to test the 4,300 level, and then has had a little rebound over the last 3 days. Well, with the fact that the government is going to be kept open for another 6 weeks, then we should anticipate that markets will bounce at least this week. But amid the circus of the government deciding whether they're going to print enough money to fund their own deficit, and it really is a circus. Uh, the one thing that hasn't been discussed at all, really, is that uh, lots of student borrowers are going to have to start making repayments on their loans after a 3 year hiatus in October. And the most recent effort by the Biden administration to end that process or to lend assistance to borrowers, and we're talking upwards of 28 million people will start making repayments in October out of a total of about 40 million student borrowers altogether. So we're talking about a pretty sizable chunk of the US population that's going to have to start making loan repayments this month. And I think that's maybe part of the reason why the market hasn't rallied more on the fact that the government shutdown has been avoided. Now, one thing that I think is most particular to pay attention to, and it's something that I've been banging on about now for most of the last few weeks, is that government bond yields are still rising. And we had quite a bit of volatility last week, where the yield first popped above the 4.5% level for the first time in years, then didn't quite like it up there on Thursday, came back down to test the 4.5% level on Friday, and is up in positive territory again in here today. And this is where you start to see some of the uh, other side of the equation when you talk about the government continuing to stay open. Because if they're going to print enough money to keep the government open, it means the deficit isn't going to contract, and therefore they're going to have to continue borrowing lots of more money. Well, if they're going to borrow more money, that means the supply of bonds is going to further increase. And if that is the case, well, that means lower prices. Lower prices mean higher yields. So borrowing costs will continue to rise. There is no real willingness within the political establishment in the USA to begin talking about the size of the deficits. When we think about back in 2011, and let's just remind ourselves what happened in 2011. We'd had gold rallying in a really impressive manner for years. And then it really picked up pace in 2011. And right around then, between 2011 and 2012, we had the evolution of the Tea Party movement. And I think that is something that is particularly relevant because the Tea Party movement in the USA, what they were primarily focused on was fiscal discipline. They didn't like the fact that the government was running big deficits in response to the credit crisis, or that the Federal Reserve was running a quantitative easing program, and they started running an election platform based upon balanced budgets. Well, that whole balanced budgets attempt was something that really helped to support the dollar. And we are not seeing that right now. But nonetheless, that was one of the factors that contributed to the gold price peaking out. Now, we've had gold going sideways for almost 3 years, and gold prices dipped down in here over the last couple of days. Now, first, let's just remind ourselves what the dollar was doing back in 2011. So, we can look in here that right around 2011, the dollar bottomed and then it started to recover. And then it really took a leg up in 2015. And now we've had a big decline in the dollar over 2022. And over the course of the last 12 weeks, the dollar has been rebounding. So that has taken a lump out of the gold price. But then, because of the efforts that are underway right now to try and curtail inflation and to bring inflationary pressures back down into the region of where the Federal Reserve would be comfortable declaring victory over inflation, well, positive real rates are surging higher. So we're up to 2.24% positive real rates right now, which means that the yield evident on the 10-year is now 2.25% more than inflation. And that is pretty close to where it was back in 2007, or at least in the period from 2004 through 6, and it's certainly marching higher. That alone is the primary reason why gold is under pressure right now. So I think when we think about what's going on, well, the Federal Reserve is willing to, it certainly appears willing to endure a recession in order to bring inflationary pressures back down again. We did have a positive print on that inflation front on Friday, and the core services less housing measure has started to come back down. Now it was recalculated, and the peak that we had in September was not quite as high as it had initially been reported. But until this measure is coming back down below 4%, then the Federal Reserve isn't going to have a lot of evidence to suggest that inflation is back under control. And I think it is probably going to require a recession to try and kill off some of that excess demand. Now, of course, there is an additional point here that the yield curve spread is starting to move back up again. Now, this is the gap between the 10-year and the 2-year, and it has risen from negative 100 basis points to negative 46 over the course of the last 3 months, and in the process, it has broken the downtrend. And this is a warning sign. It suggests that we are increasingly approaching the point where there will be a deflationary shock, where there will be a shock to growth, and unemployment will rise, and the Federal Reserve will eventually then have to start cutting interest rates in response. Now, generally speaking, that is usually when the stock market pulls back most violently. And it is usually also on this chart when that rate is pushing up through the zero bound and trending higher. That is usually when we see the greatest selling pressure in the stock market. So most particularly, this is a time to be particularly vigilant around stops, to pay attention to the highest beta companies in your portfolio, and to watch them. If they do start to roll over, sometimes it is better to take some risk off the table than to sit through declines, because we simply don't know how deep a recession is likely, or and there's lots of, I think, hopes that it will be a soft landing, but soft landings are very rare. And the pace of tightening has been very aggressive. So I think that this is a time to be vigilant and not to take big risks with one's money, and to most particularly have an idea about where to take risk off the table, and if those stops are triggered, then to hold some cash. Because we do know that when interest rates come down, when investors are frightened, and when prices are lower, well, then that is where new bull markets start. And having some cash available is going to be very beneficial for those times. And I think with that, I'll leave you for the week, and I'll wish all the best to all of you.